from the Zimbabwe Stock Exchange, and I'm going to be the moderator for this training. Thank you all once again for coming through, taking time to come through and learn about real estate investment trusts, which is a new service offering that's going to be introduced on the Zimbabwe Stock Exchange. Allow me to introduce our presenter for today. His name is Mr. Enimo Taruvinga, and he's the head of business development here at the Zimbabwe Stock Exchange. Enimo, over to you. You can share your screen.
Okay, thanks, Tapiwa, and good morning, ladies and gentlemen. And thank you for taking time to attend this training. We believe it's important that we have this conversation so that we can perhaps develop this new concept and have it going. I will be sharing my screen, and perhaps before I dig into that presentation, if you just confirm that you are able to see it.
Yes, anyway, I can see the screen.
Okay, thank you.
Yes, we can see it.
All right. So I think we are good to go. I've been introduced already. My name is Enimo Taruvinga, and I'm going to be the person leading the conversation on real estate investment trusts, a concept that we have been working, I think, with the industry over the past 2 or 3 years. The real estate investment is a key component of our asset classes in this country. I think most pension funds are heavily invested in that sector. We also have got a number of property companies listed on the stock exchange. We have got other private players as well in that industry. And I think there was a collective effort since last year to try and bring this product into life. We have got some form of movement on it, and we thought we would share where we stand currently and probably what it means for us and how we can take advantage of the movement that has taken place. We did a small survey before this session to just find out what people would want to take away from this session. So we note that we are at different stages of understanding. So we try to be basic. We also noted that there are some that have got that are quite familiar with the product. So quite kindly bear with us. If you see that perhaps you are going too basic, just bear with us. Our audience, there are some that really wanted us to be as basic as possible. We also noted that we've got practitioners in real estate, and we have people that are coming as new to that industry. So we'll try to just harmonize so that we all move at the same pace. So we'll mix a bit of theory, but we'll try to be as practical as possible. And, obviously, visualize it to our environment so that we focus on what affects us as a country. So in terms of my presentation, we'll cover the basic REIT fundamentals so that we really understand what we mean when we say REIT. It has got various definitions from one jurisdiction to the other, and to try to see how it arose and how it has evolved, and what it means for us as Zimbabwe. We also look at some of the REIT models that have been applied, and we'll just look at 2 case studies there, one for Kenya and one for South Africa. South Africa being the leading country in our neighborhood in terms of this concept. Then we'll focus obviously on us as a country, and look at what it means if someone wants to list a product, and also look at the benefits, and also look at the risks of that asset class. So to begin, we want to go back into history and really discover where this concept arose, because it shapes what we define as a REIT, and it gives a benchmark on whether we are actually there yet in terms of achieving a REITs framework. So REITs originated in the USA, and this was in around 1960 when a Real Estate Investment Trust Act was approved through their legal channels. And when this act was approved, what it did is that it then gave authority for real estate ownership, a structure which had tax treatment similar to that of a trust. So unlike our environment, and the tax experts in this audience will agree with us, that our tax laws unfortunately differ from the original concept of a trust. Our trusts locally, unless you get specific exemption, they're actually taxable. The original concept of a trust was that it should be a tax-exempt structure which allows people to put their property in a trust, and the entity itself is not taxed, but beneficiaries, when they receive a benefit from the trust, are the ones that then get taxed. So it was a pass-through structure which enabled people to have broad ownership. And the other key feature was the distribution of most of the earnings from that trust, as well as the capital gains to the investors in that trust. So three key elements there is that there was an act which was passed, and that act authorized an entity to operate without being taxed, which is the second feature. The tax exemption is quite prominent when we talk of real estate investment trusts. It can be tax exemption, or it could be a tax incentive. Those are the common features. You will find a total tax exemption or certain tax incentives that are given to this entity. And the incentive for the USA one was that it allowed what we call a pass-through feature, which means that income from the tax, from the trust or earned by the trust would not be taxed in the trust itself, but it will only be taxed when it now gets into the hands of the beneficiaries of that trust. That's what it takes a pass-through, and it means. It means the entity generally goes out, does business, generates some income, but the entity itself is not taxed on that income which it has made. When that income passes through to the beneficiaries of that trust or the unit holders of that trust, at that point, that does it then trigger taxation. So this was the feature. So those are the key features in terms of the USA REIT, an act of parliament, not necessarily parliament, they use senates, and then the tax pass through, and then the distribution. Those are three key features which you want to take away from that definition. And the reason why this concept was developed, the rationale behind REITs, was that it was found that it was difficult for small and medium-sized investors to get access to commercial real estate directly. In other words, for individual investors, small corporate investors or small institutional investors to be able to raise funds that are required to construct, let's say, a shopping mall, it's quite difficult. So the reason why a REIT was established was to provide those players access indirectly, of course, to commercial real estate. That was the major reason. And by providing access to this segment, it also meant that these institutions would be tapping into an untapped or a previously untapped source of funding. So it was a twofold rationale: one, to bring in previously disadvantaged sector or section of society to have exposure to real estate, and at the same time also opening up the real estate industry to the funding that would be availed by that sector. So those were the rationale behind the establishment of real estate investment trust, and it's the same reasons that we've actually been pushing for real estate investment trust in our own jurisdiction, to say it can provide additional sources of funding. It also opens up that sector to other players that are currently not able to participate because the sizes of investments required for direct real estate ownership are quite significant. Moving on, so how then do we define a REIT? Just so that we also can be able to define it. So a REIT is a regulated investment vehicle that enables the issuer to pool investors' funds for the purpose of investing in real estate. So a REIT, in terms of legal definition, is an investment vehicle that enables pooling funds, and those funds are pooled for the purpose, the major purpose of investing in real estate. What the investors get in return is they then get a piece of ownership into that vehicle. So investors in return, they get units in that trust, and they then also get to participate in the benefits or income that's generated by the assets under that trust. So by virtue of it being a REIT, it then provides all types of investors, be it small players, big players, gives them an opportunity to invest in large-scale diversified portfolios of income. So if it was a concept of banking, you could say this is similar to syndication, where 2 or 3 banks come together to pool resources for the purpose of on lending to a particular borrower. If you bring it to real estate, we are saying a group of people are pooling their funds together, and those pooled funds are then invested in a specific real estate project. And that way it minimizes the risk for the issuer. It also enables those small players that we've talked about access to the real estate portfolio. And this is just an illustration. We'll talk more later on in terms of the participants or the key parties to it. So there at the top you see a sponsor. This feature or this party arises because of the need for listing. You also have got a sponsor, which is a promoter of the REIT itself. We have got the unit holders on the other side. We have the REIT in the middle, and a trustee, which is an important party in that scheme. Then you've got service providers who can be property valuers or a property manager. And then you've got the investments at the bottom, different real estate assets. Moderator, if there are questions that come through, you can just interject and advise me. From my presentation, I won't be able to see.
Noted, I'll do so.
Right. Now, still on the theoretical foundations of REITs, you also need to know that there are different types of REITs. And basically, there are 2 types of REITs that you'll find, or there are 2 types of the legal structure of a REIT that you'll find. On one hand, we've got what we call a company REIT, which is a corporate structure with share capital, and it then issues shares. Your normal corporate structure that we're all familiar with. Then on the other hand, we have got a trust REIT. The name says Real Estate Investment Trust, but not all REITs are trusts. Some REITs are actually corporates. The key features, like we've said, is the issue of the tax exemption, being a pass-through structure, and having some form of distribution that's set out and clearly spelled out in terms of the earnings made by that entity. So you could have a company REIT and you also have a trust REIT. So a trust REIT is usually built on common law trust laws, and obviously the trust deed, and in return it issues units. So those are the 2 basic legal structures that you find for REITs. And breaking it down, you can also break down REITs by the theme. Most common REITs are income-oriented or rental-oriented. And these are the most common that you find. And these are obviously own and manage income-generating real estate for the benefit of investors. And these provide liquidity and stable income, obviously assuming assets being owned are generating that income. Distributions to investors are underpinned by commercial leases, and income returns are more generally predictable in an income REIT. So various names that you get for this, you can find it as an I-REIT. I will just be short for income REIT. Other jurisdictions, they call it a rental REIT. Then you also have those that focus on development, which are development REITs. So like their name suggests, these are focusing on development and construction of real estate. And obviously their income is mostly on the disposal of those assets, or they can develop for leasing, or they could be developing for disposal. But obviously the income is not as predictable as those that you find under income oriented. They are also riskier. So in other jurisdictions, the development REIT will only be allowed as a closed or as a specific offering to what they call professional investors. If you are to launch a development REIT, sometimes, especially in Kenya, you can only sell the units or the shares in that REIT to professional investors, and they've got a definition of what they call a professional investor. So it's mostly your institutional investors. It's because there's a time lag between development and generation of income under development REIT. So there's generally less liquidity, and also there's greater risk, because with development, it adds a greater component of risk. That's the other theme that you can find. Then you also have got those that actually don't focus on the physical real estate. What they do is they invest in mortgages or mortgage-backed securities and the related assets. And the income is generated through the interest income. So these are more like real estate investment trusts. So they pool funds, and when the funds are pooled, instead of using those funds to acquire physical real estate or going and actually building a bank or a hotel with those funds, they simply lend those funds to institutions that actually do the real estate development. So you also find mortgage REITs, and these are common in mostly developed countries. They are a riskier type because these then expose you to credit risk. So those are the different themes that you find in terms of REIT. So we found out that legally it could be a company structure, or it could be a trust structure. And in terms of themes, it's mostly these three: an income-oriented, a development-oriented, and a mortgage or a lending oriented real estate investment trust. Let's look at how REITs have been implemented in other jurisdictions. And I did mention at the beginning of this conversation that we'll look at South Africa. So it will be very brief. We'll not go very much into detail. But we'll
Sorry,
look at
Enwal, can I interject you? There's a question that came through.
That's fine.
Is there a major difference between a company and trust REIT, the tax structure?
All right. So there's really no difference in terms of the tax treatment between a company and a trust REIT structure. Tax laws differ from country to country, and like I said, in the USA where it was originally developed, it was developed as a tax pass-through entity, and they do allow both corporate and trust structures in the USA. But the tax law is the one that defines the benefits that accrue to the particular trust, irrespective of how it's constructed. And you probably let me go into these examples and you'll see why. South Africa is with a company structure in terms of their REITs, and the tax treatment is the same. They've got both corporates, and they do allow trusts as well. And you notice that there's no difference in terms of how they are treated for tax purposes. Once you meet the qualities of a real estate investment trust under South African law, you access the same benefits, whether you come in as a company structure or as a trust structure. So in terms of tax treatment, there's no difference, but it depends on the jurisdiction where they are established. So it's not a uniform tax law in all the countries. It differs from one jurisdiction to the other. If you go to the UK REITs, they've got a different tax structure from the Australian one. If you go to Kenya, they've got a different tax treatment, and that's why we actually brought these examples. So it will become clearer, but to answer you, there's no difference in terms of the tax treatment between the two legal structures. So we'll start with South Africa, and we'll look at 4 issues: the governing law, the legal form, the formalities, and the taxation. So in South Africa, the governing law for REITs is the Income Tax Act and the ZSE listings requirements. So they've got a unique REIT model in South Africa. You find that the entity that actually defines you to be a real estate investment trust is the Johannesburg Stock Exchange. They are the ones that were given that authority to define who a real estate investment trust is. Then in terms of the legal form, in South Africa, you can be a for-profit company in terms of their own Companies Act, or you can be a collective investment scheme in terms of their Collective Investment Schemes Act. So both structures are permissible in South Africa. In terms of the formalities, and this is where the ZSE comes in, you must be listed on the ZSE, that's one, and you should then receive what they call a REIT status in terms of the ZSE listings requirements. So the ZSE is the one that has come up with criteria to say if you want to be a REIT, this is the criteria that you have to meet. And once you meet that criteria, they then give you the REIT status. And under their Income Tax Act, what it simply does is that's recognized. Once you've got that recognition as a REIT, it then permits you to be exempted from certain taxes that we'll discuss later on. In terms of the other formality, you have to be a property entity. Again, what a property entity is defined under the ZSE listings requirements. But essentially, your significant portion of business should be in real estate, and they set a threshold of at least 75% exposure to real estate for you to qualify as a property entity. And then in terms of distributions, whatever entity you are coming in, if you're coming in as a corporate or as a trust, at the end of your financial period, you must distribute at least 75% of your PBT or your taxable income. 75% of it should be going to your unit holders or to your shareholders. Then in terms of taxation,
sorry, there's another question that just came through. When you're talking about regulations, someone is asking if we now have the regulations in Zimbabwe to allow the setting up of this. And secondly, between the two structures, the corporate and the corporate structure, I think, and the other structure that you mentioned, which one is the ZSE, the trust, corporate and trust, sorry, which one is the ZSE advocating for?
All right, so some of the questions are going to be answered when you look at the REITs in Zimbabwe. So perhaps I'll pack those. So keep those questions close by, but they're going to be explained when we focus on Zimbabwe. But in general, I'll say we have got some form of regulation now, and we can actually have REITs in the country. There are certain steps that needs to be concluded before we can actually fully say yes. For example, the Tax Act will need to be amended to accommodate the exemptions that were pronounced in the 2021 budget. So there were pronouncements in the budget, but there are certain legal steps that needs to be done to actually fulfill those wishes in the budget. So yes, we are almost there in terms of having a regulation that permits REITs in this country. I was about to look at the taxes in South Africa. So in terms of what then the South African jurisdiction does in terms, if you need those REIT status, they permit what we call a flow-through structure where distributions are taxed in the hands of the shareholder. So in essence, if a company is given the status of a REIT, it operates, leases out buildings, generates rental income, deducts the property admin fees and other expenses, the audit fees, etc., etc. Whatever remains, which should be ordinarily then be taxed it's then allowed, or it's given a mandate to say your profit before tax, at least 75% of it should be distributed to your unit holders. So the company has got a choice to distribute at least 75% or 100%. If they distribute, let's say 80%, that distribution is not taxed under the company. But whatever remains, if they remain with 20%, which they call retained, that remaining portion is then taxed. That's what a pass-through structure looks like. So if they distribute everything, the entity itself does not get taxed. The income, when it gets to the unit holder, or in this case, the shareholder, it is then treated as a dividend. So when it gets to the shareholder, you receive it as dividend. And in terms of the South African tax laws, it's slightly different from ours. The person receiving it has to treat that as income. So if your tax bracket says you are taxed depending on the amount of dividend you received, you then declare that income for tax purposes. That's how it's then treated. So the dividend is then taxed when it gets into the hands of the shareholder. The REIT itself is then exempt from capital gains tax. That is, if it's disposing its immovable property, they are not charged capital gains tax. If they the shares in a company, or if they are disposing a share in another property company or in another REIT, they are also exempted from capital gains tax. For non-resident investors, in terms of that dividend which they receive, they are charged at 20% withholding tax, subject to double taxation agreements, etc., etc. We will not go further, but we just wanted to paint a picture of how REITs in South Africa operate. Let's look at the other structure, which is Kenya, and I'll highlight that the model that we are adopting in Zimbabwe is more or less similar to the Kenyan model. If you look at the laws and the path that we've taken so far, it's leaning very much heavily towards what is transpiring in Kenya. So in terms of the Kenyan real estate investment trusts, they are governed by the Income Tax Act, and they also have got the collective investment schemes regulations, which govern their REITs in terms of law. In terms of the legal form, you find that in Kenya, unlike South Africa, REITs must be structured as an unincorporated common law trust. So in Kenya, you won't find the corporate real estate investment trust. You only find real estate investment trust, which is actually a trust. So those in Kenya actually issue units instead of shares. In terms of the formalities, you can be a development REIT or an income REIT oriented. And like we were said, a REIT must be structured as open-ended and can be converted. Only the REIT is the one that can be publicly listed in Kenya. They've set a minimum value in terms of who qualifies. They've put it at about 300 million shillings, which is about 3 million USD. They've also put a minimum of free float, which is 25%. And then in terms of distribution, we noted that in South Africa, they say distribute at least 75% of your taxable income. In Kenya, it's slightly higher at 80%. So if you want to launch a REIT in Kenya, you will know that at least 80% of your the income made under the trust is to be distributed to the unit holders. Then in terms of taxation, we noted that in South Africa, and this is where the differences come. In South Africa, it's treated as a pass-through entity. In other words, it's not totally exempt. You earn some income, you are then required to distribute 75%. If you don't distribute it, you are then taxed. But in Kenya, once you meet the definition of a REIT and you meet all these formalities, you are then exempt from income tax. And if you look at what happened during the budget, I think the Minister of Finance Honorable Professor Mtolingui, actually, this is the format which he adopted, where the REIT is actually exempt from income tax, except for the withholding tax on the dividends. So I've also put the taxes that then apply, etc., etc. But in Kenya, I also find that the REIT itself is also exempted from capital gains tax when they dispose their immovable property or when they dispose shares in another REIT. And their tax incentives go even further to shareholders, where shareholders in REITs are actually exempted from paying stamp duty. Now, there was a question on whether we have got the legal framework in the country on REITs. And so from here on, we start talking now whether we have got the framework. Okay, so we do have a framework on REITs currently, and I'll emphasize that it's not yet fully there, but to also highlight the areas that still need to be tied up for us to say we have completed that legal framework. But in terms of our current setup, we have the Collective Investment Schemes Act, we have the Income Tax Act, and we have the Securities and Exchange Act. And we have got the trust in the center. And just as I've said previously, that we are leaning towards a trust legal entity in terms of REITs in this country, and that's exactly how it's going to pan out. Let's look at how those pieces of legislation get involved in the REIT. So in terms of the Income Tax Act, I did highlight that this will need to be amended to provide for the income tax exemption as pronounced in the 2021 budget. And we'll also share what was discussed or what was pronounced in the budget. In terms of the Collective Investment Schemes Act, we have got SI 172 of 1998, which provides for the regulations on collective investment schemes. And we've got SI 240 of 2019, which amended that previous SI by adding REITs to the permissible schemes. So in any jurisdiction, you have to find a piece of legislation that actually defines what a REIT is. And in terms of our country, the definition of a REIT is found in the Collective Investment Schemes Act. That's where it is defined. And the Collective Investment Schemes Act is defined as a collective investment scheme, is defined as a trust, is defined as a fund. So that becomes the basis for us to have REITs. What the Income Tax Act will simply do is to say, once you are defined as a REIT and you meet the registration requirements of the Collective Investment Schemes Act as a REIT, you are then eligible to get this tax exemption as was pronounced by the Honorable Minister in the 2021 budget. But we'll need those pronouncements in the budget to migrate from the budget to the Finance Act. And that process, I'm sure the Ministry of Finance is actually undergoing that. So once that has been done and the Income Tax Act has been amended by the publication of that Finance Act, we'll then say we actually have got the tax provisions for it. But currently what we have is one piece of law that defines what a REIT is. But that piece of law as well is limited to the extent that if you look at the rules that were amended, these rules were initially gazetted in 1998, and they did not specifically provide qualities of a REIT. So you will have a unique position where qualities of a REIT are contained in the Finance Act, and the definition is in the Collective Investment Schemes Act. I know my regulator, the Securities and Exchange Commission, has got a draft rules which they actually circulated in the market in terms of the Collective Investment Schemes Act for REITs, but those have not yet been gazetted. So we will have a definition in the Collective Investment Schemes Act of what a REIT is, and we'll have some qualities of what a REIT is in the Finance Act. Those will be sufficient for us to have REITs being operationalized, but I think there will still be need for us to craft further legislation to define and expand what a REIT should look like. Then in terms of the Securities and Exchange Act, okay, yes, Tapua?
Yes, I have got two questions for you. Someone was asking, what's the reason for leaning towards the Kenyan structure? That's the first question.
All right, so I will explain that. So in terms of the budget announcements, you notice that it did not say you should be a trust or not. But in terms of the Collective Investment Schemes Act and in terms of SI 240 of 2019, which was published last year, it's the one that defined a real estate investment trust as a collective investment scheme or as a trust. In other words, we already have a law. So that question, well, the Collective Investment Schemes Act is the overseen by the Securities and Exchange Commission of Zimbabwe. They are the Registrar of Collective Investment Schemes Act, and the gazetting was obviously done under their purview. But I wouldn't really know the rationale for limiting it to a trust, but I must confess that we actually consulted when this piece of legislation was tabled before it was gazetted. And I would know that it also went out to some practitioners in the industry. Perhaps there was no objection at that point that there should be a corporate structure, because I remember seeing the draft of this SR. But now it's actually out there. It defines REITs in our country as just trusts. So the corporate trust is not yet provided for. If we need it to be provided for, it means we then have to lobby for SI 240 to be amended or for another piece of legislation to come into place. I was about to explain that in terms of the budget announcement, the 2021 budget, and like I said, we'll look at what was actually pronounced. One of the qualities for REITs was that it should be listed in an exchange regulated by the Securities and Exchange Commission. So that's how the Securities and Exchange Act comes in. In other words, a REIT will not be complete if we just register it with the Securities and Exchange Commission, or if we just register it under CIS Act. It will not be complete to just register it. You also then need to list it on an exchange as licensed by the Securities and Exchange Commission of Zimbabwe. Currently, we've got 3 licensed securities exchanges: the ZSE, the Victoria Falls Stock Exchange, and FinSec. So these are the 3 pieces of legislation that will govern our REITs in this country. The Income Tax Act, when it gets amended to reflect the tax exemptions, the Collective Investment Schemes, which actually defines what a REIT is, though it misses some of the qualities that have been pronounced in the budget. And then the listing part, which then brings in the Securities and Exchange Act. So the legal framework, to answer, I think, an earlier asked question whether we've got it. Yes, we have, but like I said, it has got some areas that we can improve to make it more user-friendly. But we do have a framework for it now.
Another question, Enmo. Someone is asking, if a REIT is set up in Kenya and purchases property in Zimbabwe, is the REIT exempted from the governing laws of Zimbabwe?
Not really. So, like I said, in the Income Tax Act that's likely to come out, or in the definition of a REIT, which we'll look at how a REIT is defined soon, is defined as a structure which is registered under our own Collective Investment Schemes Act, which means if it's a Kenyan entity that wants to operate a REIT in Zimbabwe, though they are a REIT in their own jurisdiction, they will still need to come here and actually register under our own Collective Investment Schemes Act. Once they are registered as a REIT under our Collective Investment Schemes Act, and they then have to also show cause that they will be able to list on any of the exchanges that are also licensed by SEC, they will then qualify for whatever tax incentives are offered in this jurisdiction. So unlike corporates, if you are listed on the Zimbabwe Stock Exchange and you're a company, if you go out to try and list on the Botswana Stock Exchange, the Botswana Stock Exchange will not normally just require you to get registered as a company in Botswana under the Companies Act. They will simply say, do you meet the listings requirements? Normally it's just whether you're a company in terms of wherever you are incorporated, do you meet the minimum capital requirements? Once you meet those, you're actually able to list on another jurisdiction. But in terms of REITs, you'll find you have to meet the specific definitions of a REIT in each jurisdiction. So a REIT in Zimbabwe may not qualify to be a REIT in Kenya. Just for example, a REIT in South Africa will not qualify to be a REIT in South Africa, in Kenya, because if it's a corporate structure, which is permitted in South Africa, so a REIT in South Africa, which is a corporate, when it moves to Kenya, they will not be able to list or to operate as a REIT in Kenya because Kenya only recognized trusts. So they will have to go and change their format to suit the REIT definitions in that country. So I'll emphasize this, that REITs are not uniform across the globe. Each jurisdiction has got its own specific requirements for you to qualify as a REIT. So no, the Kenyan REIT will not necessarily qualify for the tax incentives in Zimbabwe. They'll have to meet the specific conditions set in this jurisdiction before they qualify.
Okay,
any other questions?
Yes, I do have a couple of questions. Someone was asking, do you have a time frame within which we expect the Income Tax Act to be amended to give effect to tax exemption on REITs?
Sorry, come again.
Do we have a time frame within which we expect the Income Tax Act to be amended to give effect to tax exemption on REITs?
Okay, so unfortunately not. The authorities in terms of the amendment to the Tax Act or the Finance Act is the Ministry of Finance. Which, if you notice, some of the incentives were said to be with effect from 1 January 2021. My assumption would be they've got a plan to have something out by that time, or if it doesn't meet that time frame, but it should be soon. We did have an example when we launched the Victoria Falls Stock Exchange. We had tax incentives that were required, including an exemption. So Victoria Falls Stock Exchange is actually exempted from income tax. You also know that the capital gains withholding tax was also removed from the charges, and those were pronounced in the midterm. I think this, not in the midterm. They were announced. I think it should be in the midterm fiscal policy by the minister. But by the time we got to October, we had the Finance Act out. So I can't really determine what pace they will move to get those on board. But I think they've done it before on Victoria Falls Stock Exchange. It was quite quick. I think it was a matter of three or so months. With regards to this particular case, I can't really say I've got a time frame, because the people or the authorities doing that is the Ministry of Finance. But I'm sure they've got a plan to have the tax incentives as soon as possible.
Okay, thanks, Enmo. Another question: will a local REIT be allowed to invest in REITs in other countries? That is, buy units in REITs in other countries.
So that's an offshore investment, which is regulated outside of the normal REIT platforms. So for that, you need to approach the Exchange Control Authority. In terms of whether you'd be permitted, I do think that foreign investments are permitted, but you have to get exchange control approval on each investment that you have to make offshore. So I would say yes and no. It's not automatic that if you are rich, you are then allowed to invest offshore. You have to get exchange control approval for offshore investments.
Okay, another question, I think you're going to cover this in your upcoming slides. There was, what are the requirements to register REITs in ZIM? Confirm it's coming in your next slides.
Yes.
Okay, that's fine. Okay, so maybe I've got another one, but this one is a long one. So I'll allow this person to unmute their mic so that they can actually then ask. Dilis Tumbari, you can unmute your mic and then you can ask your question.
Okay, good morning, everyone. I wanted to ask that my concern was that we run the risk of embracing new concepts or schemes that will never manifest or acquire legal recognition. To what extent is the Zimbabwe Stock Exchange making an undertaking to follow up and ensure that the necessary amendments to laws or the creation of SIs that will ensure that the existence and operation of REITs in Zimbabwe is legally sanctioned? To what extent is the ZSE making an undertaking to make sure that they follow up and make sure that this happens within a reasonable time?
All right, thank you for that question. So we are being given a very big responsibility. Right, so we are obviously interested as a platform because ultimately the REITs have to list. But what we did previously is we worked with the REITs Association, I think it's the Real Estate Industry Association. We worked with IPEC, we worked with ZIPF. We also had some private companies. When we were lobbying for REITs, we actually did joint papers with a number of players in the industry. I don't see any harm in us exerting the same kind of strategy where we work as an industry to push for a quicker resolution. But I'm quite confident that where we are, because the budget, once it's presented, it's actually part of the legal process. Because that's why it's presented in Parliament, and once it's actually accepted, it's one stage done. The next stage is then to move the aspects that have got to do with text to a standalone act amendment, which is a bill, and that bill is obviously crafted by the Ministry of Finance. That bill will also go through Parliament and it has to pass all the stages of Parliament. Once it passes all the stages, it then gets ascended to by the President. So we have done it before on VFX, and it's a process that's doable. But yes, we will do our own part because we are very much interested in getting it. But my appeal is that let's also work as an industry to exert pressure on the authorities. I'm sure it's something that works because when we approached them as an industry, colleagues that may be familiar to this journey will testify that numerous individual players had approached the ministry in terms of REITs, but the feedback was not as positive as when we actually approached them as an industry. So yes, we'll do our part, but I think we'll still continue to work with all interested parties to ensure that it actually happens.
Okay, and the last one, maybe this is more of a suggestion that's coming through that if we can consider creating REITs that provide international diversification.
Right, so the creation of REITs, that is in terms of the property portfolio, is not really defined. It simply says you have exposure to real estate. It does not really say you have exposure to real estate in Zimbabwe. So that's still open, like I said previously. So offshore investments, I mean acquisition of properties outside, is permitted subject to exchange control approval. So a player that then wants to create a portfolio with assets that are domiciled outside of the country, they need to get that exchange control approval, and they can create a portfolio like that. So it's not really prohibited, but there are approvals that are required. So in terms of this framework, it does not really constrain an entity to just Zimbabwean properties or Zimbabwean real estate. It just says have at least 80% of your business being made or being generated in real estate. Where it's located is not really defined. But in the case of how we operate in this country, when you want to make an offshore investment, obviously you need to get exchange control approval. All right, so just a recap of what was covered in the budget, which we expect to then come out as a Finance Act amendment. So in terms of the 2021 national budget, which I said, these qualities should have been contained in the Collective Investment Schemes Act rather than in the Finance Act. Because when you define a REIT, you then should also put the qualities of what that REIT should be. So in the CIS currently, it just says a REIT is a fund which is registered by a registrar, but does not give qualities of what a REIT should be. So the qualities are the ones that were announced in the budget. So in terms of the budget, it says, in the case of investors other than pension funds, income must accrue from new real estate projects. And to expand what that means, what it simply means is for private companies that are currently in real estate, the authorities are not keen for you to move current real estate projects into a REIT structure. They would rather you develop new projects which then can be exempted from income tax. So in terms of that line, the thinking is that existing infrastructure will not qualify to be migrated if you are a private player or a private entity, which is not a pension fund. So it says the case of investors other than pension funds, what they are simply saying is private players, private real estate developers, other entities that are not pension funds, you are not permitted to move current assets or current property assets into a REIT. You can only move new or develop new assets under a REIT. So existing infrastructure will not be permitted to be moved into a REIT structure. That's what that line means. Pension funds, however, are allowed to migrate their existing portfolio to a REIT structure. Then the second or other quality is that this entity will be expected to have at least 80% of its income from real estate. So the REIT is expected to be dominated by property business. If you've got another side business going on, yes, but it should not contribute more than 20% to the total income made by the REIT. The other quality is that your REIT should be distributing at least 80% of the taxable income in the form of shareholder dividends each year. So those are the qualities for you to qualify. The other quality or qualification criteria is that in the REIT, there should be a minimum of 100 shareholders. In this case, for the proper wording would be 100 unit holders because it will be a trust after its first year of existence. So for diversification and for financial inclusion, a REIT cannot be having only 5 unit holders or 99, it should have at least 100 for it to qualify for the tax exemption. Then 50% of the shares or the units should not be held by 5 or fewer individuals. So again, this goes to the issue of diversification and financial inclusion. What that statement is saying is that if you form a REIT, and it's not a pension fund forming that REIT, it should have more than 100 shareholders, and in those 100 shareholders, 50% of the shares or the units should be held by not less than 5 people. To paraphrase it, a REIT should not have 5 people holding 50% of the shareholding. It should be more than 5 holding 50% of the entity, or there should be greater diversity in terms of the shareholding or unit holding in a REIT structure. This condition, as I've mentioned, does not apply to pension funds. So pension funds are allowed to be concentrated. It could be one pension fund holding all the units in the trust, that's fine. And then the last criteria, which was also published in the budget, was that the entity should be listed on an exchange registered in terms of the Securities and Exchange Act. So these are the qualities or the qualifications of what a REIT should be in the context of a jurisdiction, and these are likely to be carried over in the Finance Act to be amended.
Hi, Emma. Sorry, there are a lot of questions pertaining to this slide. Would you want me to go through them one by one?
Okay, let's go through them.
Okay, I think this one was from the previous slide. They're asking if in Zimbabwe, can a REIT be set up as a company or as a trust?
Okay, so in Zimbabwe, you can only set it up as a trust.
Okay, and then the other question is, what would be the treatment for incomplete projects?
Okay, so an incomplete project is not new, it's an existing one. So even if you were, say you wanted to build a residential area and you have just cleared the ground, it's an existing one. It will not qualify if it's coming under a private player. Only pension funds are the ones that are permitted to move existing or incomplete projects into a REIT. For the rest of the players, it has to be completely new. Again, I also noted that the definition of what's new probably needs to be expanded a bit, but in talking to the revenue authorities in the Ministry of Finance, their thinking is they need to protect the current income tax being generated by existing property. So property companies currently operating, they earn rentals and they're taxed. So in order to protect the existing tax base, they will only permit new infrastructure to move into real estate. So it's not really clear, but perhaps if we understand the concept that if you have got an entity currently registered and it's paying tax to government, you can't move those assets into a REIT. They need you to start from ground zero, so as to protect the tax base, which is currently accruing to government.
Okay.
So I would say an incomplete project may not qualify. Let me say use the word may. Yeah.
Okay. And then another question, some countries give unit holders over 90% minimum of their income. Do you know how and why 80% was reached for income distribution in the budget?
Okay, my thinking would be because there's the aspect of newness, especially for the private players. You will notice as we go down that in terms of the listings requirements, REITs have got limited leverage. In other words, they cannot borrow as freely as other entities. So if you need to refinance some of your projects, you have got limited borrowing space, the only recourse becomes your retained income. So 80% is also not low, especially if you look at jurisdictions. So I know it should be UK, which requires 90%. But if you look at the examples that we gave above, in South Africa, it's actually 75% only. So we actually 5 percentage points are higher than South Africa. If you look at Kenya, it's at 80%. which is, like I said, if you look at this, initially I said the path that we seem to be taking as a country is more or less similar to the Kenyan one. But I would say the 20% is room for the entity to also get some refinancing income because they've got limited leverage. You notice that this when you move on to the listings requirements, because in terms of the listings requirements, the entity is then limited in terms of how much borrowing it can actually take.
Okay. I think when you're talking about the classes of case of investors, someone's asking if asset managers are part of it, or because you only mentioned the pension funds.
All right, so asset managers are not pension funds, so they also fall under that category of investors, yes. So in other words, the wording used, so I quoted this verbatim. The wording may be misleading a bit. So in this case, they are saying anyone who wants to invest in a REIT or to be a sponsor of a REIT other than a pension fund. So an asset manager that wants to start a REIT, a private company that wants to start a REIT, a church that wants to start a REIT, except for pension funds, it has to be a new project. So yes, asset managers also counted as those investors.
Okay. I think you also answered this partly when you were talking about incomplete, because there was a question that what is the rationale for not allowing existing property assets to be converted to a REIT?
So it's the issue of the tax laws. So remember, we are moving from a taxable entity to a tax exempt. That means significant revenue loss for government. And in terms of impact, it will have perhaps significant negative impact on government revenues. So to try and protect current government revenues, they are only going to recognize REITs, except for pension funds when it's a new project. Otherwise, the existing projects are being, safeguarded to ensure that government continues to earn some sort of income from those assets. So it's purely revenue management on the part of government, so as not to lose tax.
Tax, all right, that's fine. And then when you're talking about the minimum 100 shareholders, someone is wanted clarity on if the minimum, the 100 people minimum for REITs, is it before or after listing on the ZSE?
Right. So, like I said, there's an act which defines a REIT. So, in this case, once it's defined as 100 shareholders, from an exchange perspective, okay. So, those that are familiar with law, they know there are certain laws that may conflict, but there's one that takes precedence over the other. So, in this case, the Finance Act has got precedence or takes a higher weight than our listings requirements. So in our listings requirements, we specify 300 shareholders. But because the income, if the Finance Act comes out and says 100, actually have to comply as well. So yes, 100 to qualify for listing.
Okay, I'll allow you Enmo to continue. I've taken note on some of the people who've got contribution, especially on the slide. We'll allow them at the end of the meeting to unmute their mics, and then they'll be able to share their perspective on that. So you can continue.
All right, so we are not doing too well in terms of time. I know I've got a number of slides to cover, so I'll try to quicken the pace a bit. Right, so we have talked about the issue of the regulatory framework that will govern REITs in our country, and we noted we have got the Collective Investment Schemes Act, we have got the Securities and Exchange Act, and then we'll have the CIS Act, those three pieces. Then we look at the formalities as pronounced in the budget. Then now we are looking at the taxation. So this is what it means in terms of what to then apply. So the trust will be exempt from income tax, but capital gains tax will apply on asset disposals, say for pension funds. So pension funds currently are exempt from capital gains tax on disposals, or that's what we were advised by the revenue authorities. So you'll notice that this is where we start to differ with other jurisdictions. In other jurisdictions, if you are a REIT, you are exempted from capital gains when you dispose your assets. But currently, what our Income Tax Act has only provided is the exemption from income tax, not the capital gains tax. So it also means if someone applies and perhaps they get a special exemption to move current assets, if you are not a pension fund, to a REIT, it will trigger that capital gains tax if it happens, but currently it's not permitted. So take note of that. Then in terms of investors, the tax that will then apply on the dividend that you get is the dividend withholding tax. So currently dividend withholding tax is 10%. That is the one that will apply on the dividend you get. And you'll still be charged the capital gains withholding tax if you dispose the units. So investors, because it will be a listed security, there's a 1% capital gains withholding tax that apply on the sell side. But this is only if the REIT is listed on the Zimbabwe Stock Exchange or FinSec. If the REIT is listed on the Victoria Falls Stock Exchange, there is no capital gains withholding tax on disposal. So that 1% falls away. So the 1% applies if the REIT is listed on ZSE or on FinSec. If it's listed on VFX, it's only the dividend withholding tax that will apply. Exempt investors, this will remain exempt. Okay. Now let's look at what it means if you want to set up a real estate investment trust and you are a private entity. So my definition of private is just excluding pension funds. So there are two options that you can take as a private player. But the first one obviously is to select the investment theme. If you recall, we highlighted that there are three themes. One, income oriented, two, development oriented, and three, a mortgage security oriented one. So the first thing that you need to come up with is obviously what sort of theme are you going to be focusing on? Do you want to focus on income producing real estate? You want to focus on development, real estate development, or you want to focus on lending to real estate developers? Once you have selected that, you then go on to register your scheme. And I've skipped a lot of other flesh there. So, but we'll break down what the registration actually means, and the trust deed, etc., what needs to register the REIT scheme. So you come up with the documents to register the scheme, and we'll cover those documents in subsequent slides. So you go on to register your scheme, and the registrar of collective investment schemes is the Securities and Exchange Commission, for those that may not be aware. Once you register your scheme, you can then go on to acquire or develop the real estate, and then you list the REIT on the ZSE or VFX. The other alternative is where you actually register the scheme. Once you register, you then apply for listing and raise funds through an initial public offer, and then use those funds to acquire or develop the real estate. So there's just a reversal of the two steps. The registration is unique. I mean, it's not unique, it's the same for both alternatives, but one path allows you to come and list when you already have got your real estate in the REIT. The other path is where you are saying raise funds, get listed, and then acquire the real estate subsequent to listing. So those are the two scenarios that you can utilize. For the pension fund, it has got three ways that it can develop a real estate investment trust. The first one is common. You have to select investment theme, package it in some documents, which you then approach the registrar of a real estate investment trust, get the registration. So for a pension fund, is the only entity in terms of what came out in the budget that will then be allowed to transfer certain existing properties to the REIT. So they register a REIT, and then they are allowed to transfer an existing portion of their portfolio to that REIT, and then they can list that REIT on the ZSE or on the VFX. The other path is where they register the REIT and they acquire or develop new real estate, just like a private party. and then they can then list that entity on the ZSE, or they can actually just raise the REIT, which is doesn't have any property, raise funds through an IPO, and then acquire or develop real estate subsequent to listing. So these are the pathways that you can establish a REIT, depending on whether you're a private player or a pension fund. Just to highlight that only pension funds are the ones that are allowed currently to migrate or to move their existing portfolio into a REIT structure. So the parties in a REIT that are important, the trustee, very important, and the trustee will notice that in terms of the documentation required to register a REIT will cover these parties. The REIT manager has to be licensed, so this is where I also felt that private players will find it difficult because it means you have to get a REIT manager or an asset management license for you to do this scheme, because it's a collective investment scheme. You have to get a REIT manager for it, and that REIT manager has to be licensed by SECO. So a REIT manager is not an individual; it's actually an entity licensed by Securities and Exchange Commission to provide asset management. So when you say a REIT manager, you're not referring to an individual person. It's actually an entity, like an asset management firm that can provide REIT management services. So you have to get one of those as a trust. The trust is to appoint a REIT manager. You also need a trustee, and the trustee is also to be licensed by the Securities and Exchange Commission, and the trustee has to be separate from the REIT manager. The promoter is the entity that is actually coming up with all this scheme. So it could be a pension fund, it could be a property management company, it could be any other asset manager being a promoter. Then you also need to appoint service providers, assuming you don't have this in-house, a property manager, valuers, legal advisors, and auditors for the trust. This is just an illustration of those parties from an actual existing model, which is the Kenya. So in Kenya, they've got only one REIT currently listed, which is the Stanley Fahari I-REIT. So I-REIT means income or rental REIT. And you can see what it means if you start from your right-hand side, the bottom part, that's where the trust itself is listed on the NSE. And you see that mixture that it has got 75% of assets in real estate, and then the balance is actually cash and cash equivalents. In terms of ownership, it's owned by institutional and retail investors who own 100% of that trust, and it has requirements to distribute at least 80% of their income. On the left side, you see there's a REIT manager. So in this case, this was promoted by Stanley, which is an asset management company. So the asset management company promoted the trust, and their interest obviously is the management fee which they get. Because some people may then ask, what is the motivation for any entity to actually promote a REIT? The return is the management fee. That's why it's mostly done by asset managers or pension funds that have got skills to actually manage the property portfolio, private property companies that have got the skills to manage property portfolio. What they then get at the end of the day is not the profit or loss. They then earn a management fee for running that trust or for managing that property portfolio. The trustee is a bank which works hand in hand with the manager. On the extreme left side, you find third-party service providers, and then the reporting line, like we said, this talks now to the law governing the REIT. So you find the Kenyan Revenue Authority is that Income Tax Act. The CMA is the Kenyan equivalent of our Securities and Exchange Commission, which manages the Collective Investment Schemes Act. NSE is the Nairobi Stock Exchange, which is where this entity is actually listed. So this is a structure that will exactly mirror what will happen in our jurisdiction in exactly the same way. Perhaps the service providers may be different in that Some may have this in-house. You may not need to hire third parties, but this is the structure of how it will look like, except for the percentage. In the real estate, ours is 80% in investments, and then perhaps the balance 20%. We are still looking at registration. Now going into detail, what's required to actually register a REIT. So registration of a REIT scheme is done pursuant to the Collective Investment Schemes Act. And I did mention that this act is administered by the Securities and Exchange Commission. So they are the registrar. It used to be administered by the Reserve Bank of Zimbabwe until about 2013, when that act was transferred to the Securities and Exchange Commission. So you apply to register with SEC, and the application has to be made by the trustee or the manager of the REIT. The application has to be accompanied by these documents. They are just highlighted what is important. The trust deed, the scheme's trust deed, the prospectus, and a certificate signed by a legal practitioner that certifies that the interest of every participant, blah, blah, blah. That certificate is just meant to assure the registrar that the rights and benefits of our unit holders will be guaranteed. So 3 key things in registration of a REIT scheme. You register with SEC, and the application is to be accompanied by trustees. So in the Collective Investment Schemes Act, SI 172 of 1998 that we talked about, it has got the form that you use to apply, and that form you accompanied by the trust deed. I will very soon share with you what should be in the, where you find the details of the trust deed, what should be in the trust deed. And then it has to be accompanied by prospectus as well. And that certificate, those are the 3 key things for registration. And the person doing it is either the Reit Manager or the trustee. In terms of the trust deed, it has to be executed by the schemes manager and trustee or proposed. So assuming you are coming as a private player and you are not an asset manager and you have not had an opportunity to be registered with SEC as a Reit Manager or as a trustee yet, you can actually do a joint application where you are actually saying, I want to establish a scheme and I also want to be registered as a manager or as a trustee for that particular scheme. So it's, in terms of the SI 172 of 1998, it's permissible where you submit both applications for you to be registered as a Reit Manager and registration of the scheme. So that is to be done in terms of Section 11. The execution of the deed has to be done in terms of Section 11. So Section 11 of the CIS Act contains the requirements for a trust deed. And the trustee is the responsible authority in terms of ensuring that the operations and the provisions of the trust deed are adhered to. So whatever you put in the trust deed to say we'll give our unit holders these rights, these will be the functions of the manager, this is the portfolio that we're going to invest in, our theme is income oriented, we are only going to look at this particular type of real estate. Perhaps if you say you want to focus on restaurant businesses and it's contained in the deed, the trustee becomes responsible for ensuring that you abide by whatever is contained in the trust deed. Then in terms of the items that must be covered, so I've already said they are covered in the second schedule of SI 172 of 1998. This one you can actually download from the internet and find out the details. In terms of the prospectus, so a prospectus will be required if the issuer is going to invite the public to subscribe to the issue. So in the CIS Act, it just says a prospectus. But in terms of listing, because the prospectus is a document which you use for listing, if you are not going to be raising funds from the public, you don't actually do a prospectus, you do what we call a pre-listing statement. It's not very different from a prospectus, but a prospectus is a marketing document where you actually say, come and subscribe. A pre-listing statement simply indicates that you are going to list, and this is what you are going to list. There's so many number of shares. This is our business. These are people behind it, etc., etc. It does not then call for people to subscribe to your issue. That's the difference. So if you're not going to be calling, if you're not doing an IPO, you simply do a pre-listing statement. And this should then be prepared in terms of our listings requirements. And I've put there the particular areas where you can look at. So in terms of the ZSE rules, Part 8 and Part 12 of SI 134 of the ZSE listings requirements provides you with the details that are required in a pre-listing statement. Just to highlight that the listings requirements will not be very much different from what you are accustomed to. What we are going to do is we are going to put, so some people will be alarmed that this is not okay, but we've got a section on property companies under our rules. It was not specifically meant for it because it did not contain. What we are simply doing is to appropriate the qualities of a REIT and put it in the listings requirements. And obviously, one will do additions for the purposes of listing. So in terms of that section, we are going to add the following requirements: that the REIT issuer must meet the requirements to list on the ZSE main board. So the requirements to list on the ZSE main board are that you have properly structured, meet the corporate governance requirements, certain years of operational history. In terms of the ZSE, it's 5 years, but obviously with room for entities that are younger than 5 years to be listed. The listings committee has got the discretion to waive that. Then the new areas that we are going to say is that be registered under the CIS Act, because that's the one that defines what the REIT scheme is. And we are going to determine the minimum assets. So when we crafted, so we had already drafted these rules and we had shared with our regulator, the Securities and Exchange Commission. We had put a minimum asset value of USD 1 million initially. But our regulator felt that perhaps it may be wiser to leave it open rather than specify a value, because perhaps someone comes with assets worth 950 million, 950,000, and you would want that flexibility to then permit them in. So the gross assets that you have to bring to be in the REIT will be determined by the ZSE from time to time, and you have to obviously make another taking to the ZSE. So this is where I was partly explaining that in terms of the 80-20 split between your real estate revenue lines and other business. And also the issue of the distribution, the 80-20, 80% being distributed and you perhaps retaining 20%. Is because when you are REIT and you are listed on the ZSE, the requirement is that you cannot borrow more than 50% of your total assets. So your leverage is limited to 50%. And the reason why we are limiting leverage to 50% is because the concept of a REIT is that it should mimic direct real estate ownership for the unit holders. They have to expect the rentals, that's why it's 80%, so they have to expect a great bulk of the rentals coming through to the unit holders. But if there's too many creditors in the company, it means a significant portion of that money is now being diverted to meet creditors' demands. And then that then interferes with the concept of direct property ownership, because you are no longer enjoying rental income as you were expecting, or the capital gains from the property disposals get diluted if there are too many creditors. So your leverage is limited to 50%. That's an additional requirement. The other requirement is the 80% revenue from real estate, which you are taking from the budget, the distribution of at least 80%, and we just then add to say this should be done at least by no more than 4 months after your end. So normally companies are permitted 3 months to do an audit and then we certify the results. So a month after, the distribution of the dividend should have been met. What if you then lose your REIT status because you can fail to meet the requirements of a REIT and don't get that REIT tax exemption, that income tax exemption? What does it mean for a listing? What it would mean is that if you lose your REIT status, you don't automatically lose your listing. You continue to remain a listed company, provided you meet the ZSE listings requirements. So if your free float is okay, you have been paying your dues, you are not in breach of the listings requirements, you can lose the status of a REIT. In other words, you fail to qualify for tax exemption, but it doesn't mean you have failed as a listed company. You maintain your listing, but we'll make an announcement that this entity is no longer a REIT. It's just an ordinary company, so that people don't have that expectation. Because once you lose your REIT status, it means the obligations to also distribute 80% falls away, and the investors would need to be advised that this entity, which used to be a REIT, has failed, so perhaps don't expect the dividend to come. Okay, let me skip the listing process because it's quite basic. You discuss with ZSE, appoint professional advisors, prepare listing documents, and you make your application. The next slide was just on the timetable, which I'll skip, and I'll move on to what are the benefits of this scheme. And I'll look at both sides, both the investors and the promoters. So in terms of investors, there's diversification. You get indirect exposure to real estate, and this real estate, let me emphasize, is professionally managed. So it's quite important. It's diversifying, perhaps from your normal equity, from your normal money market investments to real estate. And this real estate is professionally managed. That's why we emphasized earlier on that for registration, the registrar will actually say, I need to license the Reit Manager, is to ensure that they've got the skills to be able to manage that entity. You also, if it maintains its REIT status, you are sure to a certain extent some regular income. There's mandatory dividends that have to be shared. There's also low initial outlay, so perhaps to buy a stand these days you need about 20,000 USD, which is about 1.6 million RTGS, which you may not have. Pardon me, I think there's someone whose mic is not muted. I don't know if the host can be able to mute them. Right? Lower initial outlay in the sense that when you are purchasing a unit, it's really priced at the price per unit, but it's a unit that has got exposure to an actual building or an actual land lying somewhere. So the money that you fork out is much lower. The tax exemptions obviously means your real returns or your returns are amplified a bit. It's unfortunate that the yields from the local commercial real estate has not been quite positive, but that layer of tax, if it's removed, it actually amplifies the net yield that you actually get at the end of the day. Because also one layer is removed, so that aspect of double taxation falls away. So with the current, just to add to taxes, with the current scenario of property companies where they are taxed initially when they operate, and then they pay you a dividend, which you are then taxed on. That's double taxation. But with the REIT, the money flows directly to you and it's only taxed once it's in your hands. So it's a quite significant gain. Liquidity as well. Unlike you selling, your house, perhaps you've run out of cash or you need to pay some school fees come January. If you have got a house, it's not very easy to sell. It's not easily tradable, but with REITs, these are securities that will be on the exchange. You simply instruct your broker to put them on the market and they can trade much quicker. So they are more liquid. Regulated investment, we've talked about. So this one comes with dual regulation. We have got the Securities and Exchange Commission overseeing the Collective Investment Schemes Act. You also have got the revenue authorities looking out that the entities run well, because they also just don't give exemption for errant entities. And then you've got the listings requirements from the exchange perspective. So it's quite a secure investment asset. Price transparency, obviously, unlike houses, it's difficult to really standardize prices in real estate. The nuances of location, vicinity to certain aspects make pricing quite complex for real estate. But with the real estate investment trust, market pricing makes it quite more transparent and quite more visible. Then to the promoters, this is a tax efficient structure. Obviously, it then attracts more investors to it. And when more investors are attracted, it means you get access to new investors and you get access to more capital, which makes financing developments a bit easier. There's also the risk sharing, that instead of perhaps you've thought of building a new hotel, instead of assuming all the risk, because some projects can fail, you have got a concept where you can pool these resources by other people. So you minimize your exposure to one asset class. So there's that risk pooling, and obviously the liquidity as well, because it's a rate. When you want liquidity, you can actually do rights issues. You can issue, you can issue more units to finance certain aspects. So you've got, instead of just sitting on a property portfolio or land, which perhaps when times of crisis happen and you need liquidity, you cannot move as quickly. With a REIT, you have got access to liquidity quite easily. That the units, the entity itself can hold other units in inventory, or it can actually issue more units, and that aids to liquidity compared to the actual holdings. If it's a pension fund, it's actually even much better, that instead of liquidating the whole building, you can simply liquidate part of it by issuing units. So the liquidity of the underlying portfolio is actually enhanced. Perhaps where people have retired, there is a significant withdrawal. Instead of selling your office park, you simply issue units against that office park, and you have made your asset, your property portfolio more liquid. The risks, obviously, it's not all positive. There are risks to the investors, the normal market risk. Obviously, the prices, once it's on the market, it's now subject to demand and supply. So in bad cycles, when markets become bearish, you are bound to encounter some capital losses. When prices go down, yields, especially the moment we see companies recording voids and rental arrears, so yields are not a given that the rental yields will be positive. Sometimes they're not that high. Credit risk relates to mortgage-based ones. So in addition to those other risks, you're also exposed to mortgage risk, and that is the risk of default. So with mortgages, you are saying you're investing in a REIT, which then lends those funds to other people. So there's a risk that those people may fail to repay. That's the credit risk. Liquidity risk, especially if they are development REITs, because they are not as liquid as income-oriented REITs. For issuers, the valuation is no longer, calculation of rentals and discounted cash flow. You now have got another valuation, which is market valuation. And market valuation is not necessarily always correct. It depends on the efficiency in the market and all other nuances. Head mentality may result in a stampede for securities. All of a sudden, you are overvalued. Head mentality can also result in bearish in markets. All of a sudden, you are undervalued. There's also limited leverage. Like we said, when you listed, we limit your borrowing powers to 50% of your assets. Perhaps you wanted more leverage. There's that risk that you can borrow and take advantage of perhaps scenarios. Perhaps you've seen a property that you think is worth buying. You don't have funds. They've wanted to borrow and purchased it, but with limited leverage, you've got limited scope. You also have got land and lease. So these are now risks pertaining to real estate as well as an asset class. You have got land issues, lease issues that you have to deal with. Regulatory risk as well. land appropriation, that also comes under regulatory risk. Then liquidity risk as well. Not all assets are liquid, so you also encounter those. Ladies and gentlemen, I think this brings us to the end of the formal part of the presentation. We will now take questions, and perhaps Madam Speaker, you can tell us how much more time we have. I know we've overshot by about 30 or so minutes.
Okay, thank you, Enmo, for the presentation. I think we can allow about 10 minutes for presentation. So what I'll do is let me go through the ones that came through the chat first, and then we'll also give maybe one or two speakers to unmute their mic, and then they can then ask the question directly. So the first question is the Reit Manager request consistent without jurisdictions offering REITs?
Sorry, take that again, Tapio.
The first question is the Reit Manager request consistent without jurisdictions offering REITs?
Perhaps if the person can verbalize, I'm not quite getting the question. I don't know if you understand it. Perhaps you can paraphrase it.
Let me ask, this was from Terence Mugova, if he's still here, to unmute his mic, and then he can then ask, because I think he also had other questions, so he can then ask.
Okay.
Thank you very much, Tapio, and thank you anymore. My apologies. I seem to have made a mistake in typing. I just meant, and I think you answered it to a degree when you gave the example for Kenya. I was asking if the Reit Manager request is consistent with other jurisdictions that offer REITs, and I think you showed us there. So I think I'm answered. Not too sure if anyone else wants that further explained.
Okay, so I think it depends whether the requirement for a Reit Manager is also needed in other jurisdictions. Yes. So it's mostly required where there's the legal framework is a collective investment schemes. Where there's a corporate structure, not necessarily, but the skills of being able to manage the property portfolio, you have to present that to the listing authority to say I've got the skills. So with the collective investment schemes, unfortunately, the way it's structured is that the manager has to be licensed under the collective investment scheme, and you need that. You also need a trustee. So it's only quite peculiar to jurisdictions where the REITs are under collective investment schemes or they are come as trusts. With corporate models, it's not a requirement.
Okay, and another question was, I don't know if you had covered this in your presentation, with the listed REITs will be required to publish the NAV of the property at every market close, if it's the same, and will it be the same, in this market?
No. So with the REITs, there's no requirement to publish the net asset value of the properties. It's only required for exchange traded funds. So when you come in as an ETF, which is slightly different from a REIT, because an ETF is now open-ended, and it gives the investors direct access to the underlying assets in case they want redemption. That's the only security that requires NAV publication. But with the REIT, you are not required to publish the NAV of the underlying portfolio. You are, however, required to disclose. Obviously, that's why there's need for that valuation. When the results are presented, the valuation of the properties. So if you go in the section on properties under our listings requirements, there is a valuation which is required on a certain frequency. It should be every 1 year. You are required to have your assets valued by an independent property valuer. So in essence, it's indirectly saying disclosure. It won't be net asset value, but the gross value of your properties. You are required to have evaluation of your properties once every year by an independent valuer.
Okay, thanks, Enmo. Another question was, someone was asking if the role of the transfer secretary is falling away, I think, in the REIT structure.
Not at all. So the parties that we disclosed are mostly to do with the internal management of the scheme itself. With the listing relationship, we did not really disclose the other parties, because with the listing, you also need a sponsor, you also need a transfer secretary, and you have to also have an account in the central, an agreement with the Central Securities Depository for the dematerialized securities. So I did not disclose the other relationship that pertains to listing. I mostly focused on the internal scheme itself, the parties that are important for the internal scheme to be recognized as a scheme. When it comes to listing, it's more of service providers that would then appoint. The transfer secretary is a service provider for the share register management, the sponsor to do the applications and the intervention or the interface with the exchange, the depository for the security side as well.
Okay, thanks, Enmo. Another question was, someone was saying that in other markets, dividend distribution happen on a quarterly basis. In Zimbabwe, will we have a recommended dividend payout timetable, or a REIT can wait it out till the end of the 4-month grace period following the end of the financial year?
So at least there's a chance to give us feedback on this. What we have put in the listings requirements is that we've put a mandatory annual distribution, but we have also put a note in there to say interim dividends can be paid, but it's not a mandatory one. The mandatory one is the annual one. We are saying on an annual basis, and I know it's quite difficult to fathom, especially when inflation is high as it is currently. But it may be difficult to put a more frequent dividend allocation when things are more stable. But let me say, in the rules that we have currently, it's not mandatory for quarterly distribution, but it's permitted. What is mandatory is the annual dividend distribution.
Okay, thank you, Enmo. The other question is, what will the minimum number of units or value a retail investor would need to purchase to participate? Is there a minimum yet?
Okay, so on the retail side, there's really no minimum, though I would just highlight that in terms of normal trading, normal lots are 100 units or above. Then the broker that you may use may specify a certain minimum. But in terms of regulation, there's no regulation that says retail investors have to buy at least 100 units. It's a trading lot that we use to qualify for a normal trading board. It's 100 units. The odd lot board is any unit from 1 to 99. They can be traded. If you are going through a stock broker, they would actually set their own minimum to say, if you are going to trade through me, for me, I require you to buy this minimum. But from the exchange, we don't really set minimum. If you come through our ZSE Direct, you encounter a minimum of 100 units because that's the normal lot. But there's really no minimum.
Okay. For the interest of time, maybe let me just allow, if there's maybe 1 or 2 people who still have burning questions, to unmute their mic. If not, then I think we can always do a follow-up engagement via email. So let me just give this chance. If there's any other person who still has a burning question, please feel free to unmute your mic and then you can ask your question.
All right, any more? Just wanted to, sorry.
We seem to be having nasty feedback. I see Chandrai raised their hand. Maybe you can go ahead whilst we wait for Dilly to sort out the feedback.
All right, thank you very much, Tapiwa. Thank you very much, any more, for the presentation. I just wanted to get a sense in terms of the fee structures, which are typically organized around your rate structures. Is there a certain trend you've seen where they kept them within certain limits, etc.? Just to get a sense in terms of the fee structuring.
Sorry, if you can come back again. The fee structure pertaining to which levels?
To your service providers. So you did mention that you do have your I suppose your one-time service providers and your valuers, etc., on an annual basis. But then in terms of your rates managers and those other key stakeholders, have you seen a tendency for rates structuring to limit those kind of fees?
Right. So unfortunately not, because it's what we'll do is probably just share one prospectus and see what our jurisdictions charge, but not locally, unfortunately, because we are doing this for the first time, so we have not really noted what sort of fees applied for this type of unit trust, if you want to put it, or this type of scheme. But I know fund managers currently on equity funds, they charge anything from 5 basis points to perhaps 15 basis points, depending on the size of the fund. But it's not something that we have noted. I don't know if there are fund managers around. I don't think the Securities and Exchange Commission also regulates that aspect. But the good thing is we've got a number of managers, probably more than 20, that are licensed. So there's actually an opportunity to shop around. What I also understand is that there's vigorous competition from the current management, registered managers available. But perhaps those that have got skills for property management may not be that many. But I wouldn't have a figure. I wouldn't have a figure at the moment of how much they would charge. But what you could do is you could shop around prospectuses for a REITs that would have listed somewhere. It could give you any guidance of what sort of fee you should expect and perhaps negotiate.
Okay.
All right. Thank you very much, Animo.
Okay.
Thanks, Chandra, for that question. Kura, you raised your hand. You can unmute your mic and ask your question. Dili will give you after Kura.
Thank you very much. You talk about the CGT on the sale of the units here, let's say. Is it envisioned that the fund itself, when it sells property, would that be CGT exempt, or will Zimra want its bite?
Right, so this one, it's for private players that are not pension funds. So pension funds are currently exempted. So if it's a REIT established by pension funds, they will be exempt when they dispose within the REIT. If the REIT promoted by pension fund disposes, they are exempt. But for anyone else, the capital gains will apply if they dispose the property. So those are the areas where we're saying we have got some form of a REIT, but we have got room to actually improve it. Because if you look at the jurisdictions that we shared in Kenya, they're exempt. In South Africa, they're also exempt. But currently, for our private players, they will not be exempt on the disposal side.
Please motivate in your discussions that it could be a rollover. So the nature of the business is investing in property. You want to harvest. So giving up some of that upside that you've taken risk to create is self-defeating.
Definitely, it's something that we need to push for. We're just happy that we have started this path, but we definitely need to improve it.
Okay, thank you, Kura and Animo, for that. Dili, can you please unmute your mic and then ask, and then our last question will be from Terence after Dili.
Okay, my question is more or less similar to Kura's question. It relates to stamp duty. There was a time when you mentioned that there's exemption of income tax. I also wanted to know when it comes to stamp duty with the deeds registry. Thank you.
Not at the moment. Not at the moment. The only incentive that has been given is the income tax exemption. All the other taxes still apply unless if you are an entity that was exempted already, like a pension fund. But if you are not exempted previously, it will still apply. So the stamp duty, the capital gains tax, those will still apply. Only the income tax side is where you are exempted.
I would also go with Kura's suggestion in relation to my concern.
All right, so perhaps let me also add that what you could do, because what we, like I indicated previously, is We have noted that it's more weightier when we present as an industry. So if submissions can also come in writing to our emails, we would really appreciate it. Also helps us. Because for us, one of the questions that we got is, you seem to be pushing for players that are not interested in this product. Where are they? So it also helps to indicate to the authorities that the players themselves are also interested, and these are the issues that they really need to see. So if you could also your inputs as well in writing, it would also help us. But definitely, from our side, every opportunity we get, we will lobby for it to be improved.
Okay, thank you, Enmo. So I'll just share your email to everyone on the chat. To round it off, Terence, you had raised your hand. Please feel free and unmute your mic to ask your question.
Thank you, Tapiwa. Mine is more of a request and a justification, and I come to what Kamonera put down in terms of existing projects being excluded from conversion. My request is you consider reviewing that, because I think we may be pinching pennies and letting the real money go away when you talk about tax revenue. Because I'm thinking of it from a perspective that if it's a REIT that provides rental space for companies, it's only the rentals that may be tax exempt, but it doesn't mean that the companies that then secure those buildings still pay income tax to ZIMRA. So can we think a bit broader in terms of the potential productivity increase that we can generate by allowing existing projects that have stalled probably because of lack of funding to develop them to an attractive state, and use that thinking to say we can build a bigger base and make a more productive city or cities that will indirectly result in higher tax revenues from the corporates that inhabit those buildings. And we've got this IMT tax, it's going to hit everyone. So the logic for me sort of defeats itself.
I think I quite agree with you, especially perhaps for incomplete projects that may have stalled because of lack of funding. I think there's a good case for those ones. The existing ones, we really don't want to promise, because we have been, I think, to the revenue offices a number of times, and the reason why it was probably stalling for all these years is and they've got a genuine concern in terms of loss. It may not be material, but they still feel it's a loss. But in terms of incomplete projects, I would definitely, not to say that we want, in fact, an ideal scenario is where all real estate can be migrated to this structure, because it's more beneficial, and it's probably a better model from what we've seen happening across the border in South Africa, how the assets under REITs have actually grown from, I think, around 2007 or 2008 when they implemented this model. So noted, but I would say if we are to pin our hopes, I would think the incomplete ones have got a chance, in my view.
Okay, thank you very much. Allow me to take this opportunity to thank our presenter, Enmo Taringa, for taking us through this service offering, and also to each and every one of you guys who attended this training. And our apologies that it overran, but I'm sure it was quite beneficial, and we hope that it was beneficial to all the participants that were here. We received some messages whether this presentation is going to be shared. Yes, we'll definitely share it to everyone after the presentation. And I've shared our emails as well. Please feel free to continue engaging with us if there are any other issues that you would require. And as Enmo had said, we would really appreciate if there are any other things that you require from us. We'd also want your feedback in terms of how the training was, whether there's anything that you felt was left out, or how can also improve on the trainings that we're going to be offering. So thank you very much once again, and I do hope you have a good day and happy holidays to everyone.
Thank you, Tapiwa, and thank you, clients, friends, and colleagues